Hello, today's video will be on financial literacy. Financial literacy is the subject of what to do with your finances. In other words, it is all about money. After watching this video, you will complete the financial literacy packet given to you by your teacher. Let's begin. The first thing we're going to talk about is how to compare the features and cost of a checking account and a debit card offered by different local financial institutions. You may see the names of many of the banks that you see around town or that your parents go to. Let's talk about how to choose the right account for your needs. When you have money that you earn, it's considered a salary. The place that holds your money for you is the bank. When you take money from that bank account, it's considered a withdrawal. And money you put into your account is considered a deposit. All of these are words that we've learned before when discussing integers. Now, how can you choose the correct bank account for you? Let's look at the problem. Sebastian is choosing from 2 bank accounts below. He writes 6 checks using the ATM 3 times per month. He uses his debit card 25 times per month. Which account will be the best option for Sebastian and why? Texas Bank. Checks are 15 cents each. Monthly fee is $10. The ATM is free and the debit card is $2.50 per month. Rio Grande Bank. Checks are $2 and the first 20 checks and $5 for more than 20 checks. The monthly fee is $5 and the ATM is 10 cents per use. The debit card is $2 per month. Go ahead and answer, how much would it cost for Sebastian at Texas Bank? It would cost Sebastian for Texas Bank $13.40 to open up an account at Texas Bank. How much a month would it cost for him at Rio Grande Bank? It would cost Sebastian $14.30 at Rio Grande Bank. Which is better for Sebastian's banking needs, Texas Bank or Rio Grande Bank? I know that it would be better for Sebastian's needs if he got the Texas Bank account because those fees are more suitable to what he needs. Our next thing that we're going to talk about is distinguishing between debit and credit cards. Credit cards versus debit cards. Well, what is a credit card? When we think about credit and debit, we want to think about where our source of money comes from. A credit card is a loan that's issued, and so this is something that you've borrowed. But a debit card is money that comes from your bank account. That means it's your money. In order to repay a credit card, you would have to convert a high interest rate. However, when you have a debit card, there is no repayment needed. Again, you only spend the money that you have. For a credit card, you may have a yearly fee. And for a debit card, there's usually no fees. And if so, it's very minimal. For a credit card, you get rewards like points and miles and cash back. And usually for a debit card, usually no rewards because you're using your own money. And last but not least, people who can make monthly payments in full usually are the people that should get a credit card. And people who tend to overspend should probably stick with the debit card. So let's look at the differences and similarities for debit and credit cards. For debit card, money is withdrawn directly from your checking or savings account. If you spend more than your balance in your account, you will pay a hefty fee. For credit cards, consumers can purchase items now and pay for them later. Each purchase is a loan that is repaid later. Interest is charged if balance is not paid each month. What they have in common is that the fees may be charged for both a debit and credit card. They're small, hard plastic cards, so you may have seen both of them kind of look alike, but just know the difference, that one may be debit from your bank and one may be a loan You also may have a personal identification number or a PIN that's required. If the card is lost or stolen, you can report it immediately and they will usually replace it. Cards can be used for purchase of goods and services. So, James wants to buy a new video game system, but he doesn't have enough money in his account to pay for the video game system today. What options does James have in order to get the video game system? Answer, go ahead and check the boxes of the options that James has for this situation. Okay, what would be the best options for James? Is it to use his debit card in order to buy the system today? Well, we know that James doesn't have enough money and debit cards come from your bank account. What about using a credit card? Is it good for James to use a credit card to buy it today and pay later? It is good for him to use a credit card to buy today is because he doesn't have the money yet. So that is a good option for him. Is it good for him to save up the money and buy the system later? That is also an option. Since if he doesn't want to use his credit card and owe someone, then he could just save the money and be patient. And is it good to go to the ATM, use his debit card, and pull out the money from his account to buy the system? No, again, we stated that James does not have enough money to buy this. So, answer this question. Marlena and Jaden were discussing credit cards and debit cards. They made the following statements. You cannot use your debit card if you don't have enough money in your account for the purchase. Credit cards have a limit of the amount you can charge. You can get a credit card bill every month and have to make a monthly payment. Debit cards take the money directly from your bank balance. Which of the statements Marlena and Jaden made are true? Answer this question. All right, well, we know that the statements that they made that were true were all of the above. All of the above are true statements. Now let's talk about balancing your check register that includes deposits, withdrawals, and transfers. Your checkbook includes a check register to help you keep track of your deposits, withdrawals, and transfers. Your balance tells you how much money is actually in your account. To balance your check register, add deposits to the balance and subtract withdrawals and transfers from your balance. Let's take a look at an example. The check register shows Annie's checking account transactions. Her beginning balance was going to be $236.75. On February 1st, she deposited lawn mowing money, and she ended up with a deposit of $25. Her balance was $261.75. We know that that is going to be a deposit to the beginning balance. So now we see the difference in our beginning balance. We also said on February 9th that she wrote a check to the beauty salon, which means that was a withdrawal from her account of $28.29. Now her balance is $233.46. She also made when you are doing a withdrawal, you are subtracting from the previous balance. So we see the difference between this balance and this balance. On February 12th, she transferred money to her savings account, which was going to be about $20. And then also she did an ATM withdrawal on to February 20th, and that was $40. And then she had an ATM fee that was charged to her account, and that ATM fee was $1. Can you tell me what is Annie's ending balance? Well, Annie's ending balance is $172.46. Now, let's answer the question about balancing your checkbook. William is balancing his checkbook register for the month of March. What is the ending balance after these transactions? Find the ending balance. Alrighty, so once we do everything as far as the ending balance, we notice that if we were to do addition and subtraction, we're able to find that ending balance. And the ending balance is $638. So You may have different explanations than your friends of how you went about that, but remember that withdrawals is a subtraction and a deposit is an addition to your beginning balance. All right, let's talk a little bit about credit reports. With this objective, you're going to explain why it is important to establish a positive credit history. Let's look at Christina's credit information. Credit informations are compiled by agencies to help lenders decide whether or not to loan money to a customer. A credit report includes the person's credit history as well as personal information, employment, background, and income. So we want to look at her credit information. We know that she lives on Woodland Road. Her credit is a 19.95%. Her credit card has a 19.95% annual interest rate. She currently has a balance of $1,956 on her credit card, and it tells her social security number. She also has a checking account and a savings account at Yellowstone Bank. Her W-2, which is her annual earnings, is $14,600, $15,800, and $18,000 working part-time at Eakins Grocery. She was 1 week late on her May 2012 credit card payment. So because she had that negative situation where she was late on her credit card payment, that will stay on her credit report for 7 years. So it's super important that you make good decisions when it comes to your credit. So with a credit report, it's going to have your employment information, which is information such as your job history and income, your personal information such as your social security number, current address, and bank accounts, and of course your credit history, which is going to include information involving credit cards, including payment and balances. What is good for your credit score? Making payments on time. Bad is making payments late. Good, making your car payment on time. Bad, getting kicked out of your apartment and not paying the rent. Bad thing, insufficient funds in your bank account. It's not good for your credit score. Using your credit cards responsibly is amazing for your credit score. Maxing out your credit cards is a horrible idea when it comes to your credit score. Long history of using credit responsibly is really good for your credit score. No history of using credit responsibly is bad for your credit score. Not owing too much money is a good thing for your credit score. Owing too much money is a bad thing for your credit score. Now, let's look at the situation when it comes to Dina and Ariel. Which of these two women will be more likely to get a car loan? Read the information and decide. We know the person that's best for getting a car loan would be Ariel. All right, and answer our final test prep question. Which of the following can be damaging to a person's credit history? Number 1, paying the minimum amount due on all credit cards and loans by the due date. 2, maxing out credit cards. 3, making payments later than the required due date. 4, having several years of responsible credit history. And the correct answer is C, 2 and 3. So this completes the first video on financial literacy. Answer the questions that you've learned about so far on the packet.